Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. I'm your host, Dr. Alan Lomax, and so delighted to be back with you again today as we look at blockchain and the evolution of the real estate market with our guest, Sohail Hassan. Sohail is a multifamily real estate developer and managing partner at MarketSpace Capital with extensive experience working in energy, technology, and commercial real estate. And so Hell is a returning guest, and we really wanted him to be back on because we had a very interesting conversation with him about 6 months ago. And this enigma of blockchain needs further explanation, as it really does seem that the financial world is definitely moving in this direction. And you can learn more about Sohail by going to episode 222. And so, Sohail, tell us, what is blockchain?
Absolutely, Alan. Well, once again, a pleasure to be here with you, and thank you for the invitation to return. I take that as a good thing in that it's a subject that not only you, but your listeners are also interested in, and I'm certainly happy to be here to talk about it with you further. And I think if you recall from our last conversation, the technology of blockchain is basically allows for a unmutable public database, right? In the easiest, most simplest form, you can look at it in that perspective. And that whatever you do that's recorded on this blockchain, it is impossible to manipulate. And therefore, we can start using this technology for a number of things. Of course, probably and perhaps the most popular as currency itself, which is, of course, manifested in the form of Bitcoin, Ethereum, and a number of these other coin and tokens, right? So specifically here, though, we are looking at the application of blockchain technology to the real estate industry. Now, again, there's numerous applications now, specifically in the fintech field. There's been a number of applications of blockchain technology, credit card processing. I mean, you probably wouldn't even know it, but it's happening all in the background. And, the companies are using them and doing pilot projects in order to further develop it and incorporate it into their everyday business practices.
Well, that's interesting. I really had no understanding of it being operated in the background. The only thing that I have really heard about it is with the currency type things, Bitcoin and so on and so forth. And I have heard other tech people tell me how great it is because it's out there in the open and you can't make any transactions on it that are not transparent. Is that true?
That is exactly right. Yes. And again, every transaction basically has a little record history with it. And that record history is impossible to manipulate. So you can go back to the original creation of the block on the actual chain and be able to see the information that's stored in that block. So it's very fascinating. And again, the applications of this technology are limitless. It's just a matter, everyone has used the cliche analogy of the internet when the internet first came out and how long it took in terms of mass adoption. And here you can see that blockchain technology is doing it in a fraction of the time.
Yeah, I know.
And of course, we're globally a more connected society. So arguably, this information spreads fast. But in the sense that, even in third world countries, blockchain is being used there for everything from daily transactions, right? Where they don't want to involve any banking institutions. And in those countries where, those banking institutions cannot be trusted. So it really is opening up an entirely new, sector. And I think that in the next 10 years, you're really going to start seeing mass adoption of this in our daily form of life, from even filling up gas. Imagine, Alan, when you go to fill up gas one day, instead of you putting in your credit card, there's just going to be a QR code there. And that QR code will basically, you scan on your phone and it brings up a payment option. And you just pay digitally and you start filling up gas in your tank. So it's
Wow.
that simple.
Yeah. Well, that brings up an interesting question in my mind. The way we do it now, the financial institutions, the banks, make money on every single transaction we do with the credit card, which is a great deal for banks. But not necessarily for us. So what's that going to do with fees?
Yeah, I would entirely eliminate them.
Really?
And,
Wow.
Alan, maybe this is a good transition to, specifically talking about the application of this technology in the real estate sector. But imagine, our firm on a quarterly basis, I mean, we're doing distributions sometimes to investors all across the world. So you can imagine that amount of due diligence that is required in collecting the appropriate bank information and, processing these transactions, every one of them also requiring also a fee that would be associated with it. So imagine now that we are able to break through all of those barriers and now be able to issue tokens directly to our investors. And those tokens, of course, are, based on the US dollar. So meaning one token equals one US dollar. We use something that is known as a stable coin. And stable coin, again, it attaches it to a fiat currency. And of course, in our case, we're using the US dollar. And so your one token equals one US dollar. And as we make distributions, we're now just doing it directly to your digital wallet, completely circumventing financial institutions.
Well, this boggles my mind. I can't really comprehend this. It's such a different kind of world. I've grown up in a world where all financial transactions were governed by banks. And it's just hard for me to conceive of that not being the case. I mean, all financial transactions outside of cash, and yet even cash, we had to go to the bank to get our cash generally. So
Yeah.
This is just mind-boggling.
Well, Alan, let me ask you. I'm sure you purchase products online, correct? You're on Amazon,
Yes,
and you're buying.
yeah.
Yeah. So, I mean, I think this is the next evolution of that, right? Who would have thought one day that we would buy anything online, right? That was the craziest thing when the internet first came out. And I think, now it's second nature to us to buy something online, right? The security is in place in order for us to be able to do that. And soon, I think we're going to be evolving to this type of system where even transactions like this can happen without any type of intermediary financial institution.
Yeah, interesting. Well, another question I have in conjunction with that is this is, as you are indicating here, this really is taking those financial institutions out of many of our financial and monetary transactions. They're not going to like that. And I am sure they must be looking at this and going, how can we stop this? I mean, like the internet 20 years ago was pretty free and open. And today it is governed by a few monopolies and who are then essentially governed by advertisers. How are you going to keep this blockchain open and freely functioning?
Yeah, that's the idea behind it. And, the founder of this technology and the concept is, he basically is unknown, right? We can't even attach it to a single individual. His name is Satoshi Nakamoto. And he basically is, again, that could just be a fake name as well. So, the idea was that it would be a decentralized system and that it would not, again, require any one person, but it's using a network in order to be able to verify it. So this was a, novel concept and idea. And I think there has been a lot of pushback initially from financial institutions, but as of late, it seems that all of them, and when I say as of late, in the last 5 years or so, that all of them have embraced this in one form or another. And, they're actually using it for different processes within their own business. And, you have companies like MasterCard and PayPal, all of them are moving towards this concept of ability to purchase online securely through a tokenized format. So I think that you're going to start seeing this there. And even though the pressure from these different industries might exist, that the mass adoption of this has already taken place. And, you can see the major players that are out there right now, a lot of them have invested in, or if not, are doing research and development on blockchain and tokenization.
Well, let's turn this to real estate and how it is that blockchain can be used as a tool for real estate transactions, purchasing and buying, and perhaps even in the leasing and rental aspects of real estate.
Sure. So, Alan, in the traditional format, if I have syndicated offering. I am going out and raising, subscriptions from investors such as yourself, and you are signing a subscription agreement, which, as you know, it grants you ownership into an LLC, and that LLC typically owns the underlying real estate asset. In this particular situation, it's almost the exact same. You're still signing subscription paperwork and agreements, but as opposed to us, you having a piece of paper saying that you own 50,000 shares of this LLC, you now essentially have an agreement that's done on the blockchain, same type of subscription agreement, but we issue you 50,000 tokens. Now, these tokens represent your shares. As you recall, one token equals $1. We use a stable coin, so there's no fluctuation or volatility that inherently exists with Bitcoin or Ethereum. And so that 50,000 tokens sits in your digital wallet, similar to a Charles Schwab account that you might have. You might have an app. You log into the app and you have these 50,000 tokens that are sitting there. After 12 months, Alan, those tokens become unrestricted, and you have the ability to go and trade those tokens onto a secondary marketplace. Now, the unique thing about this is that, one, it allows liquidity in what otherwise is inherently an illiquid investment, as you know, when it comes to real estate.
Right.
So this allows for liquidity because investors after 12 months have the ability to go and start trading these tokens. Second, it allows for the fractionalized ownership of real estate. So out of the 50,000 tokens you own, you don't need to sell all 50,000. You can share 5,000. You can share 2,500, right? So what it does is it opens up the pool of investors, right? Now, somebody in Japan, South Korea, or the UK who's interested in investing in US real estate, but doesn't want to go through the whole process of the paperwork and all that, they could essentially come and make you an offer, Alan, for 5,000 of your 50,000 tokens, and you could sell your tokens there, right? And now they become the ownership of this. Now, all of this is, of course, happening on and is recorded on the blockchain, but you can imagine it's kind of creating a decentralized exchange, right, that allows trading to occur. So, it kind of solves the two biggest drawbacks. As I mentioned, one, of course, is the lack of liquidity. And secondly is, the high ticket cost that's typically associated with these real estate.
So just so I understand it here, so really essentially the same real estate structures are there in place. There's a syndication, is that correct? And
Correct.
an LLC, and
Yep. You got
rather than shares in the LLC, you're actually purchasing tokens. Is that really the
That's
only
right.
difference there?
You got it.
Okay. And so really the first year, generally, well, depending upon the type of offering it is, but we're just going to say probably in most cases, the first year you're going to have to be an accredited investor to purchase that initial offering. Is that correct?
Correct.
And then the second year that you're just selling tokenization, and so it doesn't have to be an accredited investor that you're selling to.
You got it.
Okay. Wow. So and then you can fractionalize it. You can sell it. I guess essentially you could sell it at any price that you and the buyer agree upon. Is that correct?
You got it. Correct. And so, I can give you a real life example of this and kind of break down the numbers for you a little bit, Alan. So in a ground up development of a multifamily apartment complex, which we are currently doing in Dallas, Texas, we're building 250 units there. Each of those units is costing us approximately $262,000 per unit. So roughly right around a $65 million construction cost. So that $65 million construction cost, all of those investors who invested in this project essentially invested in at that $65,000 value. Now, as we go through the construction process and we complete different phases of the project, right, then the value of that token naturally increases, right? We're spending millions of dollars now. And so, maybe through 30% or 40% through the project, that value, of course, of that token is increased. And so now once we are operating and we're in business, the same way that distributions work through the tokenized format. The same way that, the sale or refinance, and all of those are reflective of what we're doing on the side of the project. But when it just comes to the funds, everything is just being done in this tokenized format. So it allows for it to be easier, simpler. And again, it's giving our investors more options when it comes to liquidity, which no other sponsors at the moment are really doing. So that's why we see this as an opportunity. And we've spent a considerable amount of time and money on this to do a case study of sorts. So, what we ultimately found out is that, from the returns that an investor is getting, the value of that token from the beginning of the construction project, we're at $65 million. It was $1 per token. According to the appraised stabilized value, which was done by a third-party appraiser, the project is worth $75.8 million at a stabilized value. So just using that math alone, that token price increases from $1 to being closer to $4, right? And so you as a token holder are incentivized to stay through the end of the project because there's likely more meat on the bone. But I will tell you, Alan, we've had one of our investors who made a $50,000 investment who essentially went and sold those 50,000 tokens. Now they bought in at $1 per share and they exited 16 months after they made the investment at $1.31 per share. So they made a 31% increase in terms of their investment, and they did over a 16-month period. Now that investor bought it in at $1.31, knowing that, of course, it's going to go closer to $3 to $4. And so this is how it works. And all of the taxes, K1 information. If you are an investor in this project and you came and bought shares and you sold those shares in the same day, then you wouldn't be entitled to have to receive any type of K1 or tax document. If, however, you bought those shares and kept them for more than 24 hours, now you're going to start getting a K1 from us. But all of this is tracked, recorded, and managed on the blockchain.
So really the same structure is there. So if you were buying into a cash flowing property, an existing property that is cash flowing, how would you get the same kind of distributions through the blockchain?
No. Well, so same thing, the format, everything could be exactly the same as we just talked about in terms of the actual investment distributions. Those are all like logistical things. But the point that I would make here is that on a value add deal, there's not that much value that's being created, right? In a ground up deal, it's just a piece of dirt. And then now you've created this huge apartment complex. So when you go to your refinance, typically even the investors are getting a large cash out in that initial refinancing. And so, all of that takes place and can be applicable to a ground up development, but on a value add, that margin is much smaller, right? And so again, where you're at $1, you might say it's worth by $1.50 or something, once you've made some improvements to the property. So it's harder to make that justification in terms of what the value is in the token increase. But ultimately, it's all dictated by a combination of the net operating income as well as appraisals. And, because the market information, like we're trying to get unbiased confirmation on what the market thinks of the property, right? And so we have these appraisals done on an annual basis for that reason, so as to always be able to ascertain of the value and back into what the value of the token. Does that make sense?
Yeah, but so there isn't a way in the blockchain format here to give quarterly distributions. Is that?
There is. Yeah, there is a way.
There is. Oh, okay. So you could get a cash flowing property and still utilize this format.
100%. Yeah. Yes.
You just
like your digital wallet, I would issue tokens to your digital wallet that are equivalent to your distributions.
Oh, okay. Okay. So it works.
The point
really
I was making is that the value of the token is far superior in terms of what the investors can get on a ground up development as opposed to a value add investment, which is true of any investment, as you know, right?
Right. Yeah.
With ground up, there's more risk, but reward. On value add, less risk. There you go.
Right. Yeah. So this sounds like, I mean, there's a lot of benefits, particularly to investors investing in this. It seems like there's also going to be benefits to sponsors as well. So what specifically are some of those benefits?
Great question, Alan. And that was one of the things that we kind of are looking into from a sponsor's perspective, because I think everything that we've talked about up until now is how this benefits investors, right? So more liquidity options, fractionalized ownership, as you mentioned. But from a sponsor's perspective, there's really two main big advantages. I would say maybe three. First and foremost, it allows us to increase our pool of investors, because I just mentioned to you that, the initial investment is being done by these accredited investors. But imagine now, after that's taken place, you have the ability to access a network almost around the world to be able
Right.
to sell them on these tokens, right? And so it's dramatically, from a sponsor's perspective, increases the pool of potential investors. So that's one kind of the biggest selling points of this, I would say, from our perspective. And then the second thing to note here is that, on the due diligence side, right? The idea in the future, and we talked about distributions and kind of simplifying that, saving banking fees because you're avoiding wiring transactions. So those are like the simple things. But I think as you get deeper into it, as we do due diligence, for example, on a property, those quarterly updates, all of that can be published and stored on the blockchain, so that whoever is essentially buying the property in the future can go back, and there's now a very detailed repository of the due diligence related to this particular project. So it allows us to just give someone access to this repository, and they can basically go and see every single update, financials, everything. And again, it's all recorded on the blockchain, so they know they can trust that information. And it makes our life in terms of due diligence much easier, right? Now, think of all the other third-party services that currently benefit from the real estate industry. Everything from title companies to attorneys to, of course, banks, brokers. I mean, imagine all of that can be reduced or eliminated entirely by use of the blockchain. And I think a really good example of that is the title company. A title company in the modern age, and what it's going to eventually evolve to, is going to be more of, an online kind of being able to report it on the blockchain. I mean, there's already a number of industries out there, Alan, that are doing exactly this. If you Google blockchain title companies, I mean, you'll see a number of industries that are trying to disrupt and solve exactly that problem in having to work and pay title companies through these transactions.
That's interesting. I have to think more about that. So there's been a big debacle here, and that was with FTX, a crypto that went belly up, and I don't know how many investors were involved in that, but millions of dollars were lost. How do we know that isn't going to happen if we got into a blockchain ourselves?
Yeah, and so to clarify here, the issue with FTX, and FTX is an exchange, right? So similar to a decentralized exchange that you and I talked about, where you're able to trade these tokens, that's essentially what FTX is. You have the ability to go buy different tokens on there. You can convert tokens. So all of that is being managed on this exchange. And of course, it's really disappointing to see this happening in the industry. I mean, the just gross incompetence and negligence. They didn't even have quarterly board meetings. They didn't have an in-house accountant. And so some of these, really concerning things, not only because they're running one of the largest exchanges in the world, but also, as any entrepreneur or business owner, looking at that, you would be concerned and would never trust something like that. But, I think this makes the point for more regulations in this industry. And I think Congress and our government has been slow to adopt policies when it comes to regulating this space. And there you can see, any other exchange in the world has, reporting requirements and the things that they have to do. And clearly here, those were completely missed. So it's unfortunate for the industry. But, I certainly believe it's going to bounce back now. And it's important to note and clarify what FTX is. Again, it's just an exchange. So it's not a token in particular, but it's a place where you could trade those tokens. So that's akin to, in our industry, of T0, which is the exchange that actually we're using for, to trade the real estate shares. And so, T0 is one of the largest. They have 95% of the market share. And again, they are a very responsible company. It's not something that's being run in the Bahamas. So at the end of the day, we have to do our own due diligence. And I think, again, the answer to this is unfortunately more regulations. But that's exactly what will help these bad actors and eliminate them from this industry.
Yeah. Well, with any new industry, I guess you kind of have to expect that everything is going to have growing pains of different types. Well, say that I just wanted to go out and purchase a property. How would I, as just an individual operator, use the blockchain for my investors and for myself?
Well, I think that from your end, you would just contact a service provider like DigiShares, somebody that can provide the technical services of creating and minting the token. Once the tokens are created, you have the ability to, and those tokens are created essentially using your existing subscription agreement. So they all follow kind of the same terms of that agreement, but you would be able to use that and structure and the exact same investment that you do with all of your investors. And they would be able to essentially have it to where it's all being reported on the blockchain.
So is your company a service provider?
We are not.
You are not.
We are a real estate developer. Yeah. So we contacted a service provider like a company called DigiShares, and these companies would be the ones to help you structure creating the token and then being able to have a exchange like T0 where you are allowed to trade them.
So how do we know that these service providers are legitimate operators and they're not just another FTX?
Yeah, I mean, I think you have to do your research there, but I mean, DigiShares right now is really the leading, force in terms of real estate. So they're very well known. And I'll tell you, so the three main service providers we've been using, or I would say four service providers. So we have DigiShares, who actually minted the tokens. We have T0, which is the secondary market that we're trading the tokens on. And then we have a company called CompuShares, and CompuShares is the blockchain component that's tracking the trading. So as the trades are happening, it's all being recorded on the blockchain, and that is all being coordinated through CompuShares. And then the final piece is Deloitte, who's providing tax services, so that anybody who CompuShares puts in a report that owned that asset for a certain period of time, they automatically will use it to generate K1s, the tax information.
Okay.
So that's kind of the whole ecosystem. Now, of course, any of those can be traded out with another service provider, right? We went with T0 because they're the largest. They're founded by the former Overstock.com people. The founder of that founded this T0 exchange. He has since left, but they are the only SEC FINRA approved application. And, so they own a lot, as I mentioned, of the market share. And as they bring on and tokenize different companies and assets and shares, all of those users organically become traders for other assets like real estate, for example. Just wanted to point that out.
Yeah. Well, it sounds like huge opportunities there. Well, Sohail, tell our audience how it is that you can help them and how it is that they can get in touch with you to take advantage of that.
Sure. Well, I would encourage all of them to visit our website, MarketSpaceCapital.com, for more information. And, there's a section of our website that we produce white papers and blogs. And a lot of that, there's a lot more information on this. Or they can feel free to reach out to me directly. My email address is my first name, Sohail, at MarketSpaceCapital.com. And, we have always taken the stance, Alan, that we want to be as open and as transparent as possible as we go through and develop this case study on the very first tokenized ground of development. So we have a lot of information available, and I'm happy to share that with your listeners who are potentially interested in learning more.
Well, great. So, Hal, it's just been a delight having you back again. You're just so full of Great information, and I'm so glad you're so willing to share that with us. Enlightened investors, thank you once again for being with us, and join us again next episode. Sohail, thank you so much, and hope to see you again soon.
Thank you, Alan. Have a great day. Bye-bye.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.